We're going to get started with our next panel. Thank you to the TIE for hosting us. My name is Kayla Phillips. I am a VC at Hivemind Capital, and I am excited to be moderating this panel alongside my esteemed VC panelists to talk about VC fund strategy. So without further ado, let's start here with Jake and have each of our panelists introduce themselves and their funds.
I'm Jake. I used to work at a fund, L1D. I left this January to go work at a startup in the consumer sports DeFi space. Before that, I started a company in the space called Spearbit. Excited to be here.
I'm Felix, a partner at Greenfield Capital. We're a Europe-based crypto fund investing out our third fund, which is around $150 million. We focus on early stage mostly, but we also do some liquid opportunities across DeFi, infra, and consumer.
My name is Danny Sursock. I'm a partner at Archetype. We're an early stage crypto VC in New York. And at Archetype, I lead all of our research and investments across AI and deep tech.
Hi, my name's Omar. I'm a partner at Dragonfly. We manage roughly $4 billion. We invest across categories and across stages in crypto. We do everything from early stage to late stage growth. Nice to be here.
Thanks, guys. And I'll give a little bit of background on Hivemind Capital as well. So we are a crypto asset manager. We've been around for about 4.5 years now, and we're a multi-strat firm. So we invest across venture, liquid tokens, public equities, and NFTs. And on the venture side, we are actively deploying right now into companies pre-seed through Series B. We're also gearing up to raise our next fund. So maybe going in reverse order, starting with Omar, can each of our panelists tell me a little bit about your portfolio construction strategy? So do you make more or less concentrated bets? How many investments do you make within a fund? Do you look to lead or follow? And what goes into your thinking around that strategy?
Sure. So our fund's 650, and our average check size tends to be around $10 million. We'll have like roughly 50 names in the portfolio. Across stages, it really depends on the underlying business, but the thing we try and do is underwrite to venture style returns. So every individual investment could return the fund. And so we'll size according to that. So that might mean some checks are higher, some checks are lower, but with that underwriting goal in mind. And then category-wise, I would say that we tend to be like pretty payments focused these days. So a lot of stablecoin infrastructure, stablecoin issuers. Then we do a number of exchange investments. So perpetual exchanges, CeFi exchanges, DeFi, AMMs. And then outside of that, I would say like prediction markets are still like a big category for us. And so we continue to invest there. That covers like most of what we're focusing on. And then there's all the venture style returns and like seed stage checks and new things that are yet to be discovered or have yet to hit product market fit. And so we will focus on like the AI and cryptos of the world. We'll focus on net new borderland primitives, all kinds of different things that we find are interesting, but aren't necessarily open to taking in as much capital as we can do on things that have been de-risked from an investment perspective.
Yeah, at Archetype, so we deliberately keep our fund sizes pretty small. We're inspired by the USV and the benchmarks of the world. The goal, and kind of like Omar was alluding to, is to make very concentrated investments where any single investment can return the fund. And ultimately, we're playing with the incentive of carried interest. And so we're more aligned with our LPs versus just accumulating capital at scale and playing a fee-based game. We lead almost all of our investments. Check sizes range, let's say 5 million is a midpoint, but we've scaled up many multiples of that into our best companies. We invest across the entire ecosystem. For us, it's about thinking through where do blockchains really bring value add to all these different verticals and companies and use cases versus trying to force it from an ideological perspective or being overly reliant on unsustainable token subsidies, incentives, and things like that. So being true core believers in the technology. And so when we ask things like AI, for example, often what we're doing doesn't really have much of a crypto component at all to begin with today. I think if you're trying to force in crypto just for the sake of it, you're going to sacrifice investment quality. Rather, the point is thinking downstream, where can what we built as a technological ecosystem come into play that's additive? It could be on the payments layer, it could be on the coordination, the aggregation layer, it could be on the consumer application in the front end. But always just trying to be purist to building really, really good companies and bringing in crypto and blockchains in ways that are truly additive and make a lot of sense.
Cool, yeah. So we construct a portfolio with around like 40, 45 investments, also with the goal of every individual investment potentially returning the fund, sizing accordingly, or like trying to build at least 5% token ownership, double-digit equity ownership. So we do token and equity deals in general, like as I said earlier, across infra, DeFi, and consumer. So on the one hand side, basically projects that use crypto to solve some kind of real-world problem, or on the deep infra side, we've been focused to a great extent on the transaction supply chain, stuff like MEV prevention, and for example, also like on the block builder side. Privacy is something we have been focusing on a lot, and identity as well. And we also keep significant reserves in order to scale into the winners as we see them.
Yeah, so L1D sits at a really interesting spot in the industry as an allocator to funds and then also an investor into projects. On the venture side, it was a $150 million fund. You can think of that roughly as 30 positions, $5 million positions, up and down. You know, some of them are larger, some of them are smaller. And then on the liquid side, roughly a $300 million liquid fund that is exclusively allocating into hedge funds in crypto. And so in that bucket, we have about 8 positions in funds. And you know, our main strategy there is can we get into a fund at the really early stages and help kind of scale that fund to take on more institutional capital.
Great. So my next question, I'll ask to Omar first, but I'm curious to hear everyone else's thoughts as well, because I have a feeling there may be some different opinions here. So Omar, yesterday Dragonfly announced the close of their 4th fund of $650 million. Congrats on that.
Thank you.
I am curious what factors influenced the ultimate fund size, and do you think that raising a fund of that size in the current market is more of a blessing or a curse?
Yeah, I think we're really lucky that we were able to raise it. So it was good fortune. I would say it's a big blessing in this market. There's a lot of competitors, I guess, like when it comes to our business, that aren't as fortunate to have as much money as we do, and in turn, there's a lot of opportunities in this space, especially when you look at like Series A through D stuff, that we can do that not a lot of other pools of capital can't. And we're of the view that a lot of those opportunities do have venture-style returns still in them, especially when you look at the rate of growth of those businesses and where they comp against public companies. And so it's a huge blessing for us in the sense that we can play a different game than a lot of other people can, and we can play it on our own terms and be price setters in a lot of different markets, and we can play that game on a very global scale. And so we're very, very happy about it. I think it's obviously challenging to deploy it all at once, but we have the benefit of a fund horizon, and we can take our time putting it to work into spots that we think are attractive. And so I think it's a huge blessing, and allows us to be like very, very flexible, patient, and play it just at a different game. Once again, different game, different stages than a lot of other people are playing, and that reduces competition for us and sets our LPs up for really great returns.
Yeah, like I alluded to earlier, we've deliberately tried to keep our fund sizes fairly constrained. I mean, in 21 and 22, when LPs' pockets were like infinitely open, we had the opportunity, like many of our peers, to scale up the fund orders of magnitude from where we closed, and we didn't. I think one of the issues that the industry faced was venture capitalists scaled up their capital bases far beyond where the corresponding opportunities to invest in, at least the quality investments were. And so over the last couple of years, we've just had these very, very large funds forcing capital into opportunities that are either not very high quality or companies that are just not ready for these giant capital infusions. And so it kind of skews incentives and alignments and quality of outcomes, which has led to, I think, a lot of the cynicism in the industry around tokens as an instrument of value, around crypto VCs and their role in seeding seeding some of these businesses. So actually, in this most recent fundraising cycle, where I think a lot of our peers have had to downsize their funds quite a bit, it's really healthy for the industry. And I think we're going to see a reset in terms of discipline and constrained thinking around putting money behind founders that actually deserve it. And I think in the long run, that's going to be really, really good for the industry.
Yeah, for us, our fund size has worked pretty well. And I think like for our strategy, you could scale that up slightly, but you would need to compromise on the stage that you're investing at, or just write larger tickets at a higher valuation that are maybe not justified for that stage. But I mean, I can totally see also how you need kind of capital for the further growth stages of the industry, and as we move on in the next couple of years, probably there's more need for that also.
Yeah, I mean, this is clearly one of the hardest times to be a fund in crypto. It's undeniable. The number of names in the space that you would want to be in is probably like below 100. And so you're competing on every single deal out there. Having $650 million, or 500 was the question, but having that much dry powder in an environment like this means you are definitely contending as the number one. You get like first look at everything. So it's a gift for your LPs, I think. I think it might be a curse for the actual guys working there, because they gotta hustle to kind of get that money out of the door, and you gotta be everywhere. You can't miss something, because it's not gonna be every name that blows up, right? So I think it's a little bit of both. That's how I'd look at it.
Yeah, maybe just like on this point, it's not. It's funny to hear you say it's a curse. It's actually crazy because you could put that 650 to work in a span of like 6 months in this industry. Like there's enough Series C's through E's, I would say. Like even if you look at just the prediction market rounds and like some of these larger exchange rounds that have gotten done.
Yeah.
And so like you are right. It's a curse because you have to be like super disciplined because there's a lot of opportunity to spend it.
Yeah. I mean, do you want to be coming in as a venture fund at a prediction market in the 10 figures, right? It's a hard thing to do. But yeah, of course, you could write a $50 million check tomorrow.
Yeah.
So Felix and Danny, this next question is for you. Let's talk about exit strategies. So over the last year or so, the crypto M&A and IPO markets have been pretty hot. At the same time, token markets have been a little bleak. How are you thinking about exit strategies for your portfolios in terms of maximizing returns and also delivering distributions to your LPs within a reasonable time frame?
So I would say generally we do on the both hand side equity and token deals on the earlier stages. It's usually first equity with a token warrant, so there is some optionality to still kind of figure out whether it makes sense to launch a token for that particular business model. I feel like in general, like now the token markets are down, but as we are entering an era where we see like significant revenues being generated actually, and that's likely to grow. It will concentrate probably in a couple of winners, but as we see strong fundamentals, I do believe that we will see exit channels on both the equity side and also on the token side. So there will be buyers once you have that growth.
Yeah, I mean, first off, I think it's phenomenal that equity has finally been unlocked as like a viable instrument of value capture for the industry. Like that's amazing. In part because not all businesses need tokens, in part because it allows now a subset of companies in our world to integrate with the conventional financial and technological ecosystems, right? And IPOs can be great outcomes for people. I think tokens still have a lot of value, but the problem is that historically as an industry, we've approached them almost exclusively as like liquidity events, right? Almost like how SPACs were, where we're trying to force more often than not companies that are not mature enough or high quality enough or ready enough to be put into, the all-seeing domain of public liquid markets, and they get crushed as a result. And a lot of that pressure comes from what we have pitched as a class to LPs, which is like, unlike traditional venture, we have tokens, which means faster turns to liquidity. That's why you should come to our world. But I think the problem is when you're overly reliant on liquidity and the speed of liquidity at the expense of quality of businesses, you just end up with all these different problems. And so I think as an industry, we're at this reckoning now where we have to get back to the fundamentals of, yes, we have to think about how do we better align governance around tokens in a way that better approximates what we have with equities. But more than that, it's just about how do we build really quality, sustainable businesses before we introduce them to liquid markets and have that pressure so that they can actually sustain themselves at scale. And yes, projects are going to push back and say, but we need those tokens as incentive mechanisms or ways to grow and acquire customers or incentivize liquidity. But if you're relying on a token to do so, then your business is not actually very good. And so we have to get back to basics. Build really good companies and take them liquid in either equity or token markets when they're ready to do so.
Yeah, not much to add. I would say that on the token side, it's just kind of funny to watch as the industry turns tokens into quasi-equity instruments. Like this whole thing right now with buybacks. It's like one of the only ways for a token project to signal alignment with their token holders, and so you see everyone just like punting their cash flow, which they don't have too much of, back into the chart. And over time, like we're starting to see this unification. I'm sure you've seen it with Uniswap, which is the aggregation of the equity entity and the token entity, and all of that just to arrive at this endpoint being like token holders and equity holders are the exact same. And so I think, as Danny mentioned, it's going to just be a trend of people building sustainable businesses. The token is going to be the quasi-equity instrument of that sustainable business. And over time, they will be indistinguishable. We're still just kind of in this middle stage right now.
Yeah, it's funny how those two worlds are converging. Jake, question for you. I am curious to get your thoughts, given that you have sat on both the investor and on the founder side. How competitive do you think the VC market is right now, both in terms of raising LP capital as well as getting allocation in hot deals?
I think, it depends who you are. I think the raising LP capital has gone easier than people have expected this past year. And that's because the faucet for institutional flows has turned on, and it's moving. Like, there is capital coming in. People are able to raise capital. Maybe they're not able to raise as much as they wanted, but our expectations were so low in terms of capital raising when you have Bitcoin coming down to 60K, right? That it's actually better than people would expect. When it comes to competing for deals, I don't think it's ever been more competitive. All of the VCs who are alive today, who are fundraising today, have proven themselves, have track records, have something to bring to the table. At this point, they have started to develop like what traditional venture funds have, which is portfolio support, hiring support, and all the bells and whistles that you could ask for as a founder. And truly, the only edge that I can see a venture fund coming into a deal with is a long-standing relationship with the founder. And we're seeing a lot of people changing positions, changing roles, and this is creating new venture opportunities. But in order to be in these venture opportunities in the first place, you have to have a level of trust with this founder because they're going to the table with a lot of options, right? And there's capital on the table. Who are they going to pick? They're going to pick the people that they trust.
That's actually exactly the experience we've been having. So basically, one of the, I would say, most important indicators for us is whether, on one hand side, founders within the portfolio recommend us to other founders, or whether founders come back to us for their next venture, and actually we are the first to speak with them. And we have been in our first fund investors in Cello, for example, and more recently we have invested into a new project of the founder self, focused on CK identity, and yeah, we've basically collated around together with Opera and SoftBank.
I think the general ease just comes down to how good of a partner you are. And so to LPs, right, it's like too many founders and funds in our space just like call their LPs only when they need money, and they stray off of mandate, and they're sort of like disrespectful, or they take the relationship for granted. If you treat LPs like a trusted counterpart, you stick to your mandate, you don't over-raise, you invest in high quality businesses, you go to them for guidance, they will see you as a counterpart they're going to continue to trust and put money into. And likewise with founders, if you constantly show respect across the industry, both to those you deploy into and those you're just a supporter of, that reputation starts to compound in a really meaningful way. And when founders have a surplus of options at the table, they will gravitate towards those people that they think will be there, not just when markets and their company are really hot, but when things inevitably turn sour, because they always do. This is a cyclical environment. So being a good partner to both LPs and founders makes life easy or hard depending on how well you do it.
Yeah, maybe just adding on the competition stuff that Jake and Felix are talking about, but I think it's actually been extraordinarily competitive in a lot of different ways. I think like the driving force has largely been there's less entrepreneurs building in the industry. And so what that's done has made a lot more competition on the crypto native side. So any like true crypto deal, all the crypto funds don't really have a ton of other options, and so everyone crowds around that deal. And then with genius and regulatory clarity on the equity side of the house, all of like the payments deals now see all the fintech crossover funds come in. And so from our vantage point, we see it on both ends, which is like good crypto deals, everyone's all over, and then good fintech deals, all the crossover funds are all over. And so it makes it extraordinarily challenging just to do good deals in this space with the lack of supply.
So I'll open this question up to anyone that wants to take it. Is there a sector that you are excited about right now that you feel like is generally being overlooked by the market?
Yeah, I'll start. Chill my own bags a bit here. I've always thought that the two most interesting sectors in crypto are swaps and lending. Like, I don't really think crypto does anything genuinely interesting other than these two things. And so everybody's focused on the swap side. Everybody. And to me, the swap side has always been this, like, very mercenary, hard to build a moat business. Your customers are not sticky, and your margins are always decaying. And on the lending side, it's quite the opposite, right? There's a trust premium that gets built into lending. And this is what you establish a moat with. And so there's lending protocols out there, there's lending apps out there, there's a lot in the lending space that I think is just beaten up bad. And to be quite frank, I think this is like the most exciting category in the space.
Yeah, I think there are also especially actually quite interesting public opportunities on that front at the moment that we have a little bit of a look in. I think what's still a super exciting area for us is basically deep down the transaction supply chain on, especially on the Ethereum infrastructure side, where we believe that actually, I guess, Ether asset has suffered a lot compared to Bitcoin especially, and also some of the other ones, but we still believe that basically then the network effects will be remain extremely strong, that it remains the Schelling point, and there are very interesting venture scale opportunities kind of below the surface.
I think the supply side of robotics, and maybe specifically data, I think has tremendous potential to yield multiple unicorns. I think robotics in the last couple of years has seen scaling laws play out on the supply side of data, similar to what we saw with LLMs, 5, 6, 7 years ago. But the data required has to be much higher fidelity from the real world, much more diverse, and so it requires a very different sourcing mechanism than just like scraping, the open internet. But to be clear, I think it's going to take a very nuanced team that is extremely embedded in that world, deeply understands how you have an edge in terms of collecting that data, whether it's via manufacturing or different supply-side networks, and isn't just throwing like some lazy, volatile token to incentivize contributors. Like, it's going to have to be a very, very intelligent, verticalized take. But I think there's multiple multi-billion-dollar opportunities here in the next couple of years.
Yeah, maybe just on the overlooked stuff, I would say DePIN as a category just got pounded into the sand is probably a polite way of putting it over the last couple of years. But I think I started my career in traditional infrastructure investing, and I think when you look at the quality of physical infrastructure as an asset class, some of the highest duration assets that price at some of the most attractive multiples that tend to be local and geographic monopolies, and I think crypto uniquely can facilitate some of that process to start. And so I think a lot of people have just printed the category for dead. I think there's been a lot of learnings over the last 4 years as to what can go right and what can go wrong and how to start a business from the ground up. And so I think it's a pretty interesting space that no one's really looking at anymore. There's like one specialist fund that covers it, but outside of that, I think it's probably a category that people should like pay attention to again.
Danny, I have a deal for you after this. So I think we probably have time for one last question. So let's make it a fun one. Maybe we'll start with Omar and go down the line. What is one hot take that you have, either about venture or about crypto?
Maybe hot take on venture generally. I would say this is the year where a crypto fund just completely sheds the guise and turns into an AI fund. I think you're starting to see it on the edges. I think like at some point the mask comes off and we just start to see crypto funds start compete in different categories because there's not a ton for them to do or to win anymore.
Maybe a hot take on crypto VC, which is I think historically the crypto VC asset class has actually approximated an evolution of hedge funds more than an evolution of venture capital in terms of the skill set required. And I think that's actually going to change now. As crypto matures, it becomes more integrated with the traditional world. Capital bases become more sophisticated. Companies become more refined and equity-like in their structure. And I think it's going to wash out a lot of the players that have historically been quite good in this space. And it's going to require a completely different skill set. Some will make the adaptation. Some new players will come in. But a lot of the old guard, I think, is going to get pretty seriously washed out.
Yeah, one thing I think that actually doesn't make sense in the space, like loads of projects doing buybacks for most of them. I think it's a misuse of capital. You should rather invest into growth, but that means actually we need better governance models to ensure that you have very high certainty that further down the line earnings will actually will accrue to the token holders.
I think in 5 years, neither Polymarket or Kalshi will be the big player.
Great. Well, thank you guys so much. Thanks for listening, everybody.